Silicon Valley Bank just collapsed. They're one of the largest 500 companies on the stock market, and they ran out of money, and now they were shut down by regulators today. Now, to put this in perspective, Silicon Valley Bank had just over $200 billion in assets. And FTX, when they failed, had right around $10 billion in assets. Now, Silicon Valley Bank was a major lender, especially to startup companies and to other companies here in Silicon Valley in California. And because of what's going on with interest rates and inflation and the economy, they've been struggling and they weren't able to raise more money, even though they scrambled to do so in the last couple of days. And because they couldn't raise more money, they had to shut their doors. They ran out of money. So the issue here has to do with interest rates, like we've been talking about, and particularly valuations. So over the last 12 to 18 months, we've been seeing the valuation, particularly of tech companies, get hit very hard. Why? Because many tech companies, many of these startup companies had very inflated valuations, which was very normal when you have a low interest rate environment. Because when you have low interest rates, money is easy flowing. And you can easily get access to money, and venture capital firms and investment firms are fighting each other to give money to startups. And as soon as interest rates started to rise, the investment culture immediately shifted. Because before, if you could borrow money at 2 or 3%, you only need a 5% return on your money to justify the investment. Well, when you have to borrow money at 7 or 8 or 9%, now you need a 15 to 20% return on your money to justify your investment. And what's been happening is a lot of startups now are getting this pinch because the investors are saying, hey, look, we can't keep throwing money at you. We need you to generate a profit. And so the startups are saying, oh, this is a tough time to do that because one, the economy is slowing, so it's harder for us to increase our revenue. And if you can't increase the revenue, what's the alternative? Well, you can cut costs. This is why we've been seeing a lot of layoffs across Silicon Valley and tech companies, because it's a way to cut costs to continue servicing the debt. Now, sure, you can do that if you're Meta, if you're Alphabet, if you're one of the larger companies, but what if you're a startup company? What then? But a lot of startups have seen their valuations crumble. And that's bad news for investment firms, companies like Silicon Valley Bank, because the way that they work is they have a balance sheet, and your balance sheet is essentially your net worth statement as an institution. And so for a hypothetical, if you invest in 10 different startups and each startup is worth, say, $1 billion, well, now you can show a lender, look, I have these 10 assets, each one worth $1 billion. So I have a balance sheet, a net worth of $10 billion. And now you can go raise money based off your $10 billion worth of investments, of assets. And so if you do a 80% loan to value fund, that means they might be able to raise $8 billion because they have invested into these companies worth $10 billion. Well, now as interest rates have been rising very quickly, the valuations of things, particularly tech companies, have been getting slashed. And so you have some of these smaller tech startups that go from $1 billion valuation to a $500 million valuation. That's a 50% drop in valuations. So now you have banks with their balance sheet, which is now getting cut in half, maybe even more in some instances. And so you might have $8 billion worth of debt on the books, but your assets are only now $5 billion because the valuations have dropped so quickly. And the reason why valuations have dropped is because interest rates have been going up. So now the higher interest rates are putting pressure on all the investment institutions saying, we need more money. We need to show a profit from these startups, and the startups are struggling to do so because if you're a smaller company and you cannot find a way to make money, you might be forced to shut your doors.